Right now, two countries are charging tolls on the same stretch of ocean. Iran is demanding up to $2 million per ship for what it calls safe passage, and the United States has declared itself the guardian of the strait and wants 20% of all cargo value for the privilege. There is no gate. There is no booth. There is just a narrow strip of water and two navies pointing at it. And whether you drive a car, buy groceries, or have a loan, you are already paying for what's happening there. Here's how we got here, in 20 seconds. Late February, war breaks out, and tankers freeze in place. March, mines appear in the water, insurance vanishes, and the strait effectively closes. April, the U.S. blockades Iranian ships, while Gulf producers cut output because their storage tanks are full. May and June, ceasefire attempts, partial reopenings, and prices whipsawing with every headline. And now, July, the blockade is back, plus a brand new 20% American toll on all cargo through the strait. That's where the world stands this week. But this episode isn't about this week, because here's the thing. You will feel this strait, no matter where you live. First at the gas pump, within days. Then in your grocery bill, within weeks. Then in your loan rates, within months. And in your investments, all year long. Here's the promise of this episode. By the end, you'll be able to trace the entire chain, from a mine floating in the Persian Gulf all the way to the interest rate on your car loan. If you remember one number from this episode, make it this one: 20%. 1/5 of all the oil on Earth squeezes through this single passage. That's roughly 15 million barrels of crude oil every single day, plus another 5 million barrels of refined fuel on top. All of it funneling through a channel just 21 miles wide at its narrowest point. Imagine 1 in every 5 gallons on the planet flowing through a strip of water you could jet ski across in half an hour. There's a word for a place like this: a choke point. A choke point is any narrow passage where a huge share of world trade has no alternative route. The world has a handful of them: Hormuz, Malacca, Suez, Panama, Gibraltar, the Danish Straits. They look tiny on a map, but choke points are where geography becomes leverage. Control the neck, and you control the body. Now, here's the single most important concept in this entire story. You might be thinking, America produces more oil than it uses, so American drivers are safe, right? Wrong. And here's why. Oil is what economists call fungible. A barrel is a barrel, and it sells at the world price, everywhere. A producer in Texas will not sell his oil at $70 at home when the rest of the world is paying $95. He'll export it. So domestic prices don't stay low. They rise to meet the world price. That's why gas costs more in Ohio when a mine floats in the Persian Gulf. No American barrel ever touched that mine, but the price did. Let's follow one barrel to see how this reaches you. Step 1, the strait, where the trouble starts. Step 2, war risk insurance. Premiums explode. Step 3, tanker freight, shipping costs jump. Step 4, the refinery pays more for its crude. Step 5, wholesale fuel gets more expensive. Step 6, the pump price rises. Step 7, every delivery truck now costs more to run. And Step 8, that cost lands on every price sticker in every store. Here's one concrete chain. Crude, up $30 a barrel means gasoline, up roughly 70 to 90 cents a gallon. For a freight company, that's hundreds of thousands of dollars a year in extra fuel costs, passed straight into every product on the shelf. Now, here's something almost nobody talks about. Warships didn't close this strait, insurance clerks did. when war risk underwriters refuse to cover a voyage or price the coverage impossibly high. No ship owner sails. It doesn't matter how many escorts are promised. This is why government announcements don't reopen straits. Paperwork does. And it cuts the other way too. One successful attack on one so-called protected ship, and coverage vanishes again overnight. Remember this, because it decides whether any toll scheme, Iranian or American, can actually work. So if the shortcut is closed, where do the ships go? The long way, all the way around Africa, around the Cape of Good Hope. That's 10 to 14 extra days per voyage, each way, burning extra fuel the entire time. And longer voyages absorb tanker capacity, which means freight rates rise for everything, not just oil. Here's what makes this moment historic. The world's other great shortcut, the Red Sea and Suez route, was already disrupted. Two of the three great maritime shortcuts impaired at the same time. Ships have nowhere cheap left to go. Now the dominoes start to fall. Domino 1. Inflation. Because energy isn't just a price. It's the price hiding inside every other price: fuel, freight, plastics, flights, electricity, food. Within weeks of this shock, global forecasters cut their growth projections and raised their inflation forecasts across the board. In the worst-case scenarios, world inflation goes back above 6% if this disruption drags into next year. The inflation monster everyone thought was finally caged just heard the lock click open. Domino 2. The central bank trap. When inflation rises, the textbook says raise interest rates. When growth weakens, the textbook says cut them. But an oil shock does both at once, and the textbook catches fire. At the start of this year, markets expected 2 to 3 rate cuts. Then oil spiked. Now some policymakers are penciling in rate hikes. Think about that. The expected cuts didn't just shrink, they inverted. And this is where the strait reaches into your wallet, even if you don't own a car. When rates can't fall, mortgages stay expensive. Car loans stay expensive. Credit card rates stay parked at their peaks. And stocks get squeezed, because higher rates make future profits worth less today. This is the invisible tax of an oil shock. You pay it at the pump, and then you pay it again through every loan and every investment you have. There's a word for where this road can lead, a word central bankers hate to say out loud: stagflation, prices rising while the economy slows, the 1970s combination that took a decade to escape. Why is it the nightmare scenario? Because every tool that fights one half makes the other half worse. Raise rates to kill inflation. You deepen the slowdown. Cut rates to save growth. You feed the inflation. Now, an honest caveat: we are not there yet. This is the risk path, not the certainty. And it depends almost entirely on one thing: how long the strait stays contested. Here's a hidden domino almost everyone is missing. The world is watching oil, but the bigger bomb may be natural gas. Crude oil has partial escape routes, pipelines that bypass the strait. Natural gas from Qatar, roughly 1/5 of the entire world's supply, has no pipeline detour. Every molecule exits through Hormuz. Prolonged closure models assume gas prices rising roughly twice as much as oil. And that's not an abstract number. That's electricity bills in Tokyo, Seoul, and Berlin. And natural gas is the raw material for the next domino, because natural gas is what the world makes fertilizer from. And this strait carries over 30% of the world's urea exports, the fertilizer behind wheat, corn, and rice. Follow the chain. Expensive gas makes expensive fertilizer. Expensive fertilizer makes expensive planting. Expensive planting makes expensive crops. And expensive crops make expensive grocery bills, everywhere, but hardest in the world's poorest countries. Oil shocks hit your wallet in weeks. They hit the world's food supply in seasons. The harvest planted during expensive fertilizer becomes the expensive bread of next year. Everything we've covered so far is the visible war, the one measured in dollars per barrel. But underneath it, a second war is being fought, a quieter one, over something much bigger: which money the world uses at all. For 50 years, the world's energy has run on a bargain nobody ever formally signed. It works like a triangle. Gulf producers sell their oil priced in dollars. The profits get parked in American government bonds. And in exchange, the American Navy keeps the sea lanes safe for free. The result? Everyone on Earth needs dollars to buy energy, so everyone holds dollars. So America can borrow more cheaply than any nation in history. It's been called the most successful business arrangement nobody signed. And that's what makes this moment different. For 50 years, the security was the free part of the deal. Now The Guardian is charging 20%. Protection as a subscription service. Set the politics aside. Here's the economics lesson. When a free public good becomes a paid service, every customer starts shopping for alternatives. Every country watching just learned the same thing. Depending on one currency's rails is now a taxable vulnerability. And history offers a warning. Once one power charges tolls at a choke point, others start asking, why not Malacca? Why not Gibraltar? And the shopping for alternatives has already started, in the strait itself. Reports say tankers that settle their oil trade in Chinese yuan are being allowed through, while dollar-linked ships wait or take the long way around. Even the Iranian tolls are reportedly payable in yuan or in stablecoins. A split market is forming in the world's most important waterway. Yuan barrels sailing, dollar barrels detouring. And squeezed importers now face a currency choice they never wanted to make. For the first time, de-dollarization isn't a conference topic. It's a condition of passage. So is the dollar finished? No. And it's important to understand why. First, the yuan is not freely convertible. China controls who can exchange it and when. A currency you can't freely exit can't be the world's reserve. Second, yuan-settled oil is still only around 5% of world trade, and most of it is still priced in dollars, merely paid in yuan. Pricing is the fortress. Settlement is just the moat. Third, nothing on earth matches the depth of the American bond market for parking trillions in national wealth. Empires don't fall to challengers overnight. They erode, a few percent per crisis, never recovered. Which brings us to the quiet winner of this entire story. If you can't fully trust the dollar's rails, and you can't really use the yuan's, what's left? The one asset that is nobody's liability and nobody's hostage. Gold. Central banks, especially across Asia and the Gulf, have been buying gold at a record pace for years. And every choke point crisis, every frozen reserve, every new toll adds to the same quiet logic. Gold doesn't need a strait, and it doesn't need permission. One more domino, the slowest one, and the one historians will care about most. The world oil market is worth $2 to $3 trillion a year. For decades, a large share of those profits flowed back into American government bonds. That's the recycling loop. But if oil money increasingly parks elsewhere, in gold, in other currencies, America gets fewer automatic buyers for its debt. Fewer buyers means America pays more to borrow. And when America pays more to borrow, long-term interest rates drift up for everyone, everywhere. This domino falls over years, not weeks, but it's the one that rewrites textbooks. Now, let's step back and breathe. Because history has something reassuring to say. 1973, 1979, 2008, 2022. Every single time prices spiked, economies staggered, and within 1 to 3 years, prices normalized. Every single time. And even now, the market is betting the same way. Oil for delivery next year trades far below today's price. Traders are pricing a crisis, not a new era. But here's the other half of history's lesson. Every shock leaves a scar. After 73, fuel efficiency standards and strategic petroleum reserves were invented, and never went away. After 79, Iran's oil output never recovered. It's still millions of barrels below its old peak 5 decades later. After 2022, Russian oil left dollar rails permanently. Prices are cyclical. Architecture is permanent. So watch what gets rebuilt differently this time: stockpiles, pipelines, currency rails, and gold vaults. So how will you know when this is actually over? Ignore the speeches. Watch the ships. Signal 1. War risk insurance premiums falling. That's the real all-clear. Underwriters move on facts, not announcements. Signal 2. Tanker transit counts recovering. Ships moving daily through the strait, not press conferences about them. Signal 3. Next year's oil price versus today's. When that gap closes calmly, the market believes it's over. And Signal 4. The price at your own pump. The last domino to fall back, always a few weeks behind the others. The oil price will come back down. It always has. But when the world's most important waterway became a toll road, and the world's most important currency became a weapon, what did every country quietly decide to never depend on again? The prices will recover. The trust might not. And that is the market's story. A quick snapshot of where things stand as we publish. The Strait, contested. The American blockade of Iranian ships is back. The 20% toll has been announced, and traffic remains far below normal. Crude, trading around $78 to $83 a barrel, up sharply on the toll news, though well below its earlier peak near $119. And the talks, on again, off again, everything agreed one day, new demands the next, no durable deal yet. By the time you watch this, some of these numbers will have moved. The mechanics you've just learned will not. One last pattern to keep in your pocket. A strong dollar plus costly oil plus costly food. That's the squeeze formula. Countries that import their energy and owe their debts in dollars get hit from every side at once. Their import bills balloon, while the very currency they need to pay those bills gets more expensive. It's the same pattern behind the debt crises that have hit importing nations across South Asia and Africa in recent years. When you see all three ingredients together, watch the weakest links.